All right, welcome everybody. This is John Rothe at Riverbend Investment Management. Welcome to my big picture weekly market update. This is for the week of October 28th, 2022. So taking a look at what's been going on in the markets here, we've been talking about this for most of the year, is this relationship between the S&P 500 and the US dollar. And really, as the US dollar has risen this year, it's been punishing stocks. And we can see just the impact that the rising trend in the dollar has had on the S&P 500. Well, now we're a bit at an inflection point here where the dollar looks like it's maybe starting to roll over. It's starting to get weaker and weaker. And that's been benefiting stocks over the last few weeks here. If we look at our US dollar, our daily chart here, we can see it's breaking down a little bit below our support levels here. We're seeing a changeover in weakness in momentum. However, we are a little bit oversold here, so we might get a little volatility and sideways movement here in the US dollar. It's not going to, I don't think, it'll be a clear drop off. If we look at our longer term and zoom out a little bit and look at our weekly charts here, we can see exactly what's going on here. We're starting to see weakness in momentum. We're starting to see just a divergence here, negative divergence. And when we see divergences like this, it's usually an indication that that overall trend is about to change. So again, we're keeping a close eye on the dollar because obviously the dollar starts to get weaker and weaker. That's going to benefit stocks here in the US. Now, part of the reason this is happening is there's starting to be some worry here in the systems, especially overseas, that something may break in the economic cycle, in the economic system. We're starting to see other central banks start to step in. For example, Canada, that was widely expected to raise rates 75 basis points, and they didn't do so. They took their foot a little bit off the brake because, again, they're starting to worry about things locking up, especially in the bond markets. We're overseas, we're seeing central banks come in and intervene in their currencies because they're just getting destroyed by with the strength in the US dollar. So the anticipation is that the Fed meets next week and they're anticipated to raise rates, again, 75 basis points like expected. But what people are going to be closely watching is the language, what comes out in their statements afterwards. And people are expecting them to, again, take their foot off the brake a little bit, maybe reduce their indications of how aggressively they're going to raise interest rates going forward because people are worried about something in the bond markets or overseas markets starting to seize up because of this relationship with the US dollar versus everywhere else. If we look at market strength over the last week and a half has been favoring value stocks, which is interesting. Growth names have typically been the leaderships, and we're seeing just still continued weakness in the growth names, especially technology, semiconductors, where the value names like industrial, financial, utilities, energy are starting to really take leadership roles within the market. If we look at our relationship between growth and value stocks, this is just a relative relationship between the two of them. And what this is as the line rises, as this blue line rises, is favoring growth stocks. It's telling us that growth stocks are outperforming value. And when the lines decline, it tells us value is outperforming growth. Well, we've had this upward trend here. And every time we've hit this trend, we've seen a reversal where growth starts to recover. And especially we saw a great example of that earlier this year where we came down to this trend line of this relationship, and the market took that as an indication that growth stocks were oversold, and they started putting money back into that. And that's why we saw a bit of a rally over the summer that especially favored the growth names. Well, this relationship is starting to break down, and we're starting to see more and more of the market start to favor the value names. So this could be potentially a changeover where we start to see value names become a leadership name in the market, maybe going on for the next decade. So it's an area that's very interesting to watch because this relationship looks like it's maybe starting to change, and we might start to see a relationship changeover that we really haven't seen since 2013, 2014. I mean, this has really been favoring growth stocks really for the last 6-7 years. You can really see this highlighted well if we compare growth and value. This is the S&P 500 growth. You can see it's been rising up since the lows earlier in the summer, but nothing too aggressive. It hasn't been really a straight line up. If we look at the value names have really been just going straight up, and you can see just that difference between growth names and value names and where that strength is, and that those investors, and for the most part across the street here, investors are really favoring value names. We look at the Dow Jones versus the S&P 500. Dow Jones is more of a price-weighted index, where the S&P 500 is more weighted on market capitalization, which means the S&P 500 is still overweight in growth names, especially technology names. And you can see the impact that we're seeing, the difference in just returns based on that favoring the value names, and how the S&P 500 is starting to underperform because, again, those technology and those growth names are starting to underperform, and they make up so much of that index right now. Taking a look at the S&P 500 itself, I've been talking about this area here that's highlighted right in the middle as an inflection point. We've had a downward trend. We had our 38% retracement level off the COVID. This is basically the retracement off the COVID highs, from COVID lows to the COVID highs. And as you can see here, the retracement levels typically act as a level of support and resistance, especially for a lot of the algorithmic traders, the computer-driven trading models. And as we break out here, we're starting to see more and more interest in the market. Now, the market's getting a little bit overbought, but we're starting to see improving momentum. And there are some hurdles here. We have our cloud model, which tends to act as support and resistance. And we have that overall downtrend line. But it seems like the market is starting to wake up and is starting to favor stocks again and starting to allocate more and more money, especially if the Fed starts to pivot a little bit and change their tone going forward. However, again, everything's not safe. I wouldn't go out there and blindly buy into the market. I think it's still going to be a sector selection, stock selection market that's going to favor people that are more selective within the market. You can look here, Facebook or Meta, for example, as it's called nowadays, down about 74% from its highs. We had Amazon come out last night, release earnings. It's down about almost 9%, down about 8% for the day. But you can see here from top to bottom, it's down about 45%. So these were leadership names for so many years that have just been getting absolutely destroyed lately. And part of that is I think people are starting to favor value names. And if you have any type of weakness in your stock, people are just running for the doors very, very quickly. Taking a look at the bond market, this is our AGG, which represents our broad bond index. And you can see here we had this major decline in the bond markets, and it's starting to rise up again. It was very oversold, and bonds are starting to think that maybe the Fed is starting to look at potentially pivoting a little bit, and this needs to get repriced in because the bond market was really looking at a very aggressive Fed. And if it goes from very aggressive to even aggressive, that's going to change and have to reprice in some of these models, which again, that's why we're starting to see some of these bonds wake up. We look at our Merrill Lynch High Yield Index. This is an index I like to follow because it typically can be a good indicator if we have risk off or risk on in the investing environment. This is our 50-day moving average line in our purple. And I like to look at this line again as kind of that threshold for how risk averse or how aggressive investors just really across the broad market here are being. And you can see here we're starting to break out above this level here, which again is another good sign that's potentially favoring stocks going forward. We look at our seasonality. Again, this is another theme I've been talking about for the last couple of weeks here. We're starting to enter that seasonal trend here that favors stocks. We're getting to the end of October. November is historically very strong. December, January, this is where you really start to see some strength in the market, especially historically. And this is, investors like to look at historical trends. And if we start to see any type of pickup in the market, those investors that like to follow historical trends are going to start to follow along too, and starts to almost become a self-fulfilling prophecy as people start to see what's going on in the market here. We also have this trend here, the 4-year presidential cycle. We've been talking a lot about this year as well. We're starting to enter that period of time where if the market's going to rally, it's going to do so because this pre-election cycle and the election cycle tend to be very strong as whatever's going on with the economy in the world, people start to talk about making changes. And this is where you start to get some type of rally in the market because people start to talk about ways to fix whatever is broken in the economy or within the world. So again, something to keep an eye on because a lot of this is starting to line up and look like we may be starting to enter a trend that lines up with what's historically happened. So a lot of things to keep an eye on. The big thing again is the Fed meets next week. We're going to keep a close eye on their wording and what they say. And I think that's going to really potentially highlight what the next couple of months are going to look like in the market. So that's it for this week. Again, if you ever have any questions, please feel free to reach out to me. The best way is at john.rothe@riverbendinvestments.com. If you're on Twitter, you can check me out at John Rothe. I post more daily charts and things of that nature as well. So again, hope everyone's doing well. Hope everybody has a great Halloween weekend. And feel free to reach out to me if you have any questions or concerns at all. Thanks so much. Bye-bye for now.